Welcome back, everyone. Michael here with Offshore Citizen. Today I'm going to discuss with you what I'm going to call a new theory of value. And the background of this is I intuitively liked and found interesting the idea of value investing. So for those of you who are not familiar, what is the basic principle of value investing? The basic principle of value investing is you identify the value of something and you buy it for less than that. And if you do that, you're going to generally make more money than you will lose. And over time, somebody else who's not doing that will generally tend to do worse. Now, this is one of the main theories behind, I would say it's like one of the main theories of investing which tends to outperform the market over time, okay? The other one arguably being growth investing. I mean, there's a few different ones, but anyway, for me, as somebody who was just kind of approaching it and looking and saying, okay, like what are the ways that I can do better with my investing? This made a lot of sense. I was like, okay, great. And so, I bought real estate, and I always encourage people, if you're looking for real estate, try and buy for less than the market value. You can go and look at stocks and try and do the same thing. You can go and do that with some private business. You can do it with buying loans, right? You can sometimes have a distressed loan where you can go in and you can see for some reason that it's got a certain value, and you can come in and buy it for less than that and basically immediately have some upside. So there's lots and lots of examples of this. Now, the problem with this theory is it doesn't very well account for how you figure out what the value is. And so in this video, I'm going to talk to you guys a little bit about a different idea, about a way of looking at how valuable things are. And I'll discuss a little bit some of the more traditional ways, and then I'll discuss where I see those kind of failing, and then a way that is possibly interesting for other types of assets, okay? Before we do that, if you haven't already, please hit the subscribe button, hit the notification bell. I hope you appreciate the content. If you do, please check out some of our other videos. I try to make great content for you every single day. And if you would like help with international structuring, international tax planning, moving abroad, setting up your company abroad, opening companies, getting residencies, getting citizenships, all this global type stuff, please reach out to me. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below. Or send us a message through offshorecitizen.net or offshorecapitalist.com. Okay, now, let's dive in. What are we talking about here? Well, if you look at traditional value investing, usually it's based on the idea of profit. And that's fine. You can look at it from the standpoint of a bond, right? A bond produces a certain amount of interest, or the coupon rate of the bond, right? So for example, for those of you who aren't familiar, a bond is basically just a loan. And so I lend out $100,000, which is basically what I do is I buy a $100,000 bond, and then I'm getting a certain rate of interest over time, right? Maybe it's, in today's market, let's say 2%, right? So this means $2,000 a year is being paid out as cash flow. And I can measure things relative to that because I can say, okay, well, if I know that this bond is going to be worth that much in the future, then if something else is going to produce more cash flow, then it should be worth more in the future. And if it's going to produce less, it should be worth less in the future, et cetera. Okay, so this gets very technical, and you can read Warren Buffett recommends the book The Intelligent Investor, which is kind of like the original one, and then there's a book called Securities Analysis, which is a much more deep examination. And there's many, many examples of other ways that people have figured out, discount cash flow models and all these different, all kinds of things. This being said, how does that work for something like gold? How does it work for silver? How does it work for art? How does it work even really for real estate? Now, for real estate, you can say, okay, well, the rental income, you can kind of figure out and project forward, et cetera, and figure it out on that basis. Okay, like there's something to be said for that. But a bunch of assets today don't have any cash flows. And yet, we know that they have value, right? If I go and I buy a Gucci purse and I buy a Zara purse, one is worth more than the other, but neither of them produces cash flows, so how can I tell? Now, what Warren Buffett would say is, hey, listen, you can't value something that has no profits, right? So, for a long time he would say, hey, listen, these tech companies, you just can't value them. That's it. I don't know that that's necessarily true. One way that you could sometimes do it is you could look at the assets, right? That was kind of the traditional way of doing it, was you would actually look at the net current assets of a company, and you'd say if it was selling for, below net current assets by some percentage, then that would tell you something. And current assets, there was a usefulness to that, but most of those, the concepts of Ben Graham, securities analysis and the intelligent investor, were created and run back in, the like 40s or earlier in the 40s, I guess. So because of that, they've been used a lot, and a lot of those deals that were met that traditional standard have all been eaten up, and so there's not so many good opportunities from that standard. So, you need to find different ways of looking at it. You could pay attention to things like in social networks and similar companies, you can look at the value per user, and they kind of loosely try and say, okay, the valuation should be $100 per user, and so if you've got, a billion users, you've got probably $100 billion valuation, things like this that you can kind of roughly correlate. That being said, it's really easy to have a company that loses money and has a lot of users and is going to go into the crypto or go into the abyss, right? So what I think is more interesting is to not think about it necessarily from that standpoint and think of it instead in terms of the velocity of money. And this is very interesting for predicting bubbles, okay? So if something's going up in price, what does that mean? It basically means that money is going in faster than it's coming out. If the price is going down, it means that money is coming out faster than it's going in. And if the price is staying the same, then typically you're saying that money is going in at the same pace that it's going out, right? And of course, the price changes those dynamics. So there's kind of this weird feedback loop, right? Because if the price goes down, then people might be more willing to sell or might more want to hold, just depending on who the psychology is. Some people might be more willing to buy at a lower price so that you bring in more buyers, but at the same time, other people were scared. So, you get this dynamic playing out. This being said, I think there's a really useful metric, which is what is the sustainable rate that money can go into or out of an asset, okay? So let me restate that. What is the sustainable rate that money will go into or go out of an asset? And I'll give you an example of this in terms of this last little crazy crypto wave that they had. Now, one of the ways to know that that was really dangerous was I had people calling me from, who I've known for years, who really don't have much money, who are like, hey, listen, where do I put my $1,000? Now, what do I know about that? I know this is an inherently unsustainable money flowing in there because after they put in that $1,000, they don't have another $1,000 to put in. So if you're saying, hey, listen, I'm a very, normal, conservative working person maybe, or business person, I make X dollars per month, I take 10% of that, I put it into the investments. Is that a sustainable flow of capital? Yeah, that's pretty sustainable, right? Makes a lot of sense. If, on the other hand, you're like, hey, I have a one-time inheritance and I'm putting the money in there, is that a sustainable flow of capital? No, that's not a sustainable flow of capital. So that might cause the price to go up a lot, but over time, you should see it rebalance to the sustainable flows, right? Same concept if we look at any of these assets, really, right? Now, there's times, of course, that something will attract more money over time, but if the flow of money exceeds what is sustainable about it, you know that you're in a bubble, okay? And so then the question might be, well, how do we know that, right? I think that you know it in a few different ways. One is you kind of have to pay attention to the market and the market participants and say, like, hang on, where's that money coming from? So one of the things that's been going on over the last little while is people were getting these stimulus checks. They were getting free money. Now, is that money sustainable? No, that money's not sustainable, right? So, okay, you got a $2,000 check from the government and you put it into the, basically roulette table of investments. Great. Okay. What about next month? Is there going to be another stimulus check? Well, then that's not sustainable. And of course, we know that at some point that's going to peter off. So we know that that's a problem, right? Likewise, if we look at debt. So when we get these debt bubbles, what's happening? Well, people can only borrow for so long, right? The debt is going to mount, and that's unsustainable money, right? If you have money that's not fueled by debt, then you're like, okay, I can afford to hold, I can put some more money in, I can take money out, not such a big deal. So in that sense, yeah, I think it's just very interesting to look at from that perspective. You can probably to some extent determine this based on volumes, okay? So if volume peak, and why do I mention this? I mention this because this is a data point that you can typically have, right? So if you see going way up, then you can figure that probably those volumes aren't going to sustain, right? At least not in the short run. They're probably going to level back off. And as a result, you would expect the moves, either upwards or downwards, to correct. And so if you're thinking about, hey, listen, should I be putting money in right now? Well, if the volume is really flowing, if you're late in a volume flowing up stage or late in a volume flowing down stage, because of course, if you catch it early, then that can be different, then you kind of have to expect a correction, okay? So I don't know if that's useful to you guys. Hopefully it is. Just to think about it in order avoid getting yourself burned, to, hey, listen, where is there unsustainable amounts of money going in? Now, let's think about the opposite, which is because we want to find some opportunities, right? We want to say, hey, where can I go find some investment opportunities? And I'm going to give you an example, which is Malaysia, okay? Malaysia has been cheap for a long time. To give you some idea, the Malaysian real estate market is, the last I checked, lower on an inflation basis than it was in 1990, okay? Now, you can sit there and you can say, well, there's excess inventory and the long-term prospect, or at least the immediate prospects don't look too bullish and things like this. I agree with all that, right? There's too much inventory. You can go there, you can see new towers that are empty, and you can see new towers going up, and you can go on the real estate websites. They're a little bit deceptive because you get multiple copies of the same listing, but you'll see a lot of inventory, more than the market can handle. And this explains in part why the prices are depressed. However, let's just look at the last year, okay? So I've been following these markets for, I don't know, maybe like a few years anyway. And I can tell you the prices were already fairly attractive, but I looked at them and I thought, well, the problem here is that you've got all this excess inventory. I don't necessarily think the prices are going to necessarily go up. Well, now let's take a look at it though. We have had a year where suddenly the money that was going in has been pulled out. We've had two things that have happened simultaneously. Number one is it's basically been closed up to foreigners. They've really locked that country down and not made it open. What has this meant? The foreign capital that would normally come in there hasn't been coming in. At the same time, you've got a bunch of foreigners who had MM2H visas who have been largely locked out of the country. They've had a really difficult time, and they have investments and properties, etc. How do you think they're feeling? A lot of them are saying, hey, listen, I'm getting screwed here. I can't go to this place that I own. You know what? I'm going to sell. You put more volume on the market, right? So you have two simultaneous factors, which to me are short-term unsustainable, okay? In other words, these are not going to continue. We have a massive decrease in the volume of money going in, and probably an increase in the volume of property being sold. Obviously, you know, you get different areas, etc. But that to me is quite bullish, right? This to me is a situation where there's a reason to believe that that could represent a good buying opportunity sometime around when things, sometime in the near future, right? Does this mean it's going to go to the moon? It doesn't mean any of that. But it does mean that it should revert. I would expect some kind of correction. And of course, it depends a little bit on what you can negotiate for deals and all that kind of thing. But that's an example. Let's look at a flip example. If I pay attention to the Lisbon, Portugal market, okay? In Lisbon, Portugal, if you had bought at the start of the golden visa and held till now, you did spectacularly well. Spectacularly well. What happened? Well, you had an unusually large amount of money coming in, paying for properties to buy for the golden visa. We saw something similar for the citizenship program in Cyprus, right? Now, they're changing the golden visa so that the only way that those investments are going to take place in Lisbon is via these funds. Now, I think that's possibly bullish for these funds and interesting. I've done some videos about that, but I'm a little bit concerned. Now, some people will tell me when I talk to them, they say, you know what, we're not worried about that. It's only 3% of the money in the market. 3% actually can make a pretty big difference, you know, in terms of what goes on here. You're also going to have people who went through the cycle of their golden visa, got citizenship, got permanent residency, whatever, and now they're selling because they don't need that anymore. So you have kind of, again, these inverse pressures that to me, not like a great market, right? On the flip side, let's go and look at what's happening. Well, they're saying, hey, listen, we're not going to put the money into Lisbon, Porto, some of the coastal areas. Instead, we're going to put it somewhere else. Well, those areas aren't used to having this money. So what would I expect? I would expect those prices are going to go up, right? I can go and I can pick around all sorts of different areas to figure out what might be places where the volume of money is, the velocity of money going in there is going to increase or is going to decrease. And I can pick based on what's a good market. A good market is a market where the velocity of money has been down for quite a while. Ideally, it's going to pick up, right? But it's dropped for some artificial reason. In this sense, I can look at the Turkish market, which has been very successful with citizenship by investment. And, you know, real estate hasn't done as badly as you might expect given the Turkish lira. In fact, it's sustained fairly well. Do I think that's a great market? Not necessarily, because I don't really see the signs at this stage that things are going to turn around and you're going to have a flood of new money into that market. So take that for what it is. I think it's useful to look at from that perspective. and you can kind of go accordingly. So I would love to hear what you guys think. Is this helpful for you? Does it give you any insights? Do you have some particular markets that you think are good and there's going to be a lot of money flowing in there, or bad because money is going to be flowing out of there? Please let me know in the comments. If you would like assistance, again, reach out to me. If you have an opportunity, check out our other YouTube channel, solutionspodcast.com, where we have heterodox, just crazy idea conversations about kind of solutions for the world's problems. And I'm going to look forward to seeing you guys on the next video.